Okay, so I kind of wanted to make another video. Let's call this Getting Out Debt Fast Part 2. Basically, I want to explain some of the principles behind using velocity banking. I've already saw some questions pop up, so I just want to go over some of the terms and how things work with these, the best of my knowledge anyway. So for those who don't know, a HELOC is a home equity line of credit. Now, typically with banks, they will allow HELOCs. They're not necessarily great interest rates because they're higher than whatever the 30% or 30-year loans are. So right now, 30 years are running around 7%. You may pay 9 or 10% on a HELOC. The difference is that you only pay on what you owe for those on average for the month. Okay, so it's going to be a little higher rate, but it's going to be still lower than what you're using it to pay off for debt. Second rule that I know of for sure, you must have at least 20% equity, actually more than that, because they won't let you go above 80% loan value. So if your house is 200, if 20% of that would be 160. So anything that you have in equity below 160, you could probably use a HELOC to get you back to 160. But that's the most it's going to be. So if you owe 120, you got 40 grand to work with. Okay, but again, that's going to depend on you and your credit and your situation. Now, a lot of people use these to pay off high interest credit cards, even though the rate may be higher than a typical mortgage. It's usually a lot less than what an average credit card interest rate is, because right now those are running like 23%. Now, if you have better credit, you might have a 16 or 18%, which is still crazy ridiculous because personally, I have a credit union account, and I have a credit score over 800, so I get the best rate they have, and it's 8.99 is the most I pay for any revolving credit on my credit card. But you can't get that anywhere else, basically. Now, the other thing I move along on this, one of the reasons that I like this method, this velocity banking idea, is because a lot of people cannot follow the snowball method long enough to make real impact. And that's because it works, but it takes forever, right? Because what you're doing is, according to the Dave Ramsey idea, is that you're doing rice and beans and beans and rice to find any scrape of money so that you can apply an extra $50, $100 a month to your first victory bill, which would be the lowest balance you have. And then you snowball that minimum payment you were making on that you just paid off with the rice and beans money you've saved, and you continue on until you've paid everything off. And I can tell you that it can take years and years and years and years and years, and you have to be really good with your budget. And a lot of people just struggle following long-term budgets. It's just too tight, and it doesn't allow for life to happen, because life does happen. $1,000 emergency fund, especially nowadays, is nothing. I would recommend for a lot of folks is that don't worry about having $1,000 in emergency fund per se. Just have $1,000 available credit card that you could use, because it's the same thing. Pay it off, fix the item, because at least if it's your refrigerator that goes out, it's going to cost more than $1,000 to get a new one. So if you have credit card that's got a balance available, of $1,000 easily or more, that would be an alternative. Now, one of the things I do like about using the credit card system that I showed you and talked about, is that what it does allow you to do is that if you are credit worthy, it'd be a great opportunity to take advantage of a 0 interest rate credit card. And then you get that new card, roll your previous balances into it, and take advantage of the 0%, especially if you're using this idea to pay off credit card. If you're using it to pay off a car loan, which is the situation I explained, I would continue to just use whatever credit card you have available that's got a low interest, that's something that you can pay off every year or every month. But the idea is that you're only going to pay the minimum of that credit card until you pay off and use all your cash value and cash flow to pay off the item that you have to have cash to pay for, like a car, right? Or your house. You can't continually put $10,000 in credit card debt on your car or on your house. Okay, and the credit card company's not gonna allow you to pay for a car with a credit card, as far as making payments. So HELOCs will allow you to do that, and using your cash flow to do that by using your credit card to pay those monthly or weekly cash flow items like gas, food, especially. Those are the big ones because those are the biggest impact that most people have. In our situation, we spend approximately $300 a week, $300 to $400 a week. So let's just say $400 on the high side. Well, that $400, if I use a credit card instead, I'll have $400 in cash every week that I could put toward my car loan, which is one of the ways we did it. And you can roll up and pay off things very quickly that way. And then when you're done, you just take the same money plus the car payment you just paid off, put them together, snowball it, and then use that to pay off the credit card until you get the balance done and over with. So I don't suggest you continue to do this to run debt because you want to have your credit card paid for every month. You don't want to have revolving debt on that credit card either because it is higher interest than most things. Another idea that I'd like to throw at you, and I've done this as well before. We had a large bill that was going to cost a crazy amount of interest, and I had a car that was paid for. So I refinanced the car to the bank and used that money to pay off the high interest debt that I had. And that got me into a car loan at 3% versus this other debt that would have been 12% or more. So if you have that available cash is a good way to do it, or have something of value. Dave Ramsey's big thing is to sell everything that's not attached, that you don't need and can live without. Get a second job. I don't want to see you in a restaurant unless you're working there. That principle sucks. Okay, there's better ways to do it besides sacrificing your entire life to pay off some debt. But you got to be smart, and you got to be good with your money, and you have to understand what your budget is and what your needs are. Okay, so after everything's paid for, you just reapply all this information of the money and the cash flow to the credit card debt. It's not that hard, really. It's just using simple math. If I pay all these things with a credit card, that frees up this amount of cash. This cash can go toward this car loan. When that car loan's paid for, I can apply that car loan and this cash back to the credit card until the credit card's paid. Okay? Anyway, just wanted to clear up a few things. Again, we'll call this part 2. And maybe if I continue talking about these things, I'll go part 3, part 4, etc. So if you have any questions or comments, I appreciate if you leave them in the comments below. Thanks for watching. We'll see you next time.